It is my esteemed pleasure to bring on another illustrious guest to talk about a concept that I know you guys don't know anything about, but you're going to love it when you get introduced to it because it explains a lot. It is the underlying, it's like the force. It permeates all of existence and connects us and binds us. And it explains why things happen. All right. I know it's a weird introduction, but it will make sense in a minute. I'm going to bring on Tim Quast, CEO of Market Structure Edge. Let's get on even footing here. How's it going, Tim?
Very well. Thank you, Neil. I appreciate that introduction. This is the Skywalker session.
That sounds great. Anytime I get to insert a Star Wars reference into one of these boot camps, I do so. So for the uninitiated who haven't heard from you, Tim,
yep.
Would you mind giving a brief introduction to yourself and what you're doing over at Market Structure Edge?
You bet. And as ever, thank you, Neil. Always good to be with you. So market structure is the behavior of money behind price and volume. And so Market Structure Edge is designed to give retail traders the opportunity to see how the market works. If we don't know how something works, how could we expect to beat it? And it has changed. And I'm going to explain that. But we take a very rules-based approach to the market because it is heavily regulated. And those regulations create a way for us to see supply and demand. And if you can turn supply and demand to your advantage, as is true in the economy, you can make money. And that's what Edge is about. And I've spent 20 years doing this. I say I've wasted my adult life on market structure, so you don't have to.
Thank you, Tim. So market structure. When you say market structure, I think it means a couple different things to different people because I see it being used and perhaps misused all over the place. So Tim, when you say market structure, what does that mean?
So I define it. In fact, I'm going to cover this very briefly in the presentation as the behavior of money behind price and volume in context of rules. You will hear the term thrown about, and most people don't know what it means. But every market has a set of mechanics, whether it's the grocery business, the auto business, and the supply chain in the auto business, and how the chip shortage has affected the auto business. Those are all aspects of the market structure of the auto industry. Well, the stock market has a market structure too. There is money behind the scenes that waxes and wanes, and there are rules that govern it, and it's observable. I like the analogy of a grocery store. There are consumers that come and go in the store and consume things, and it's measurable, and that is market structure. That's the mechanics of the market.
Wonderful. And so you've got a presentation for us. Are you able to share?
I do. Screen? I can. Yeah. Here we go. And I intend to do two things here, barring, let's see, that didn't work, did it? Here we are.
It looked like it was like there for a second, and then it disappeared.
Okay, I think we're in now.
We're in. You just got to switch what's on the screen now.
Okay, let me do that. How's that?
Boom, baby.
Good.
You got a presentation.
Okay, I will do. This will take 15 minutes or so, and then I will go to the proof in the pudding on the platform. So that's my plan.
Let's do it.
Okay, here we go. Okay, well, thank you for spending 30 minutes on this. That's, if you want to clear a room at a cocktail party, start talking about market structure. I joke about that, but our aim today is to talk about how to beat buying and holding by trading supply and demand. And that might sound sacrilegious because one of the orthodoxies of the equity market is, well, you can't time the market. You can't beat buy and hold. Well, let's check. Let's study the math. And I want to offer two things. One sobering thing, it's September 11, 2021. And 20 years ago, you probably remember where you were. And I feel like we're carrying on a very important tradition of freedom, productivity, multiplying our talents. And we get to carry that baton from the people who did not survive on September 11, 2001. And I was in the World Trade Center buildings then multiple times. I've been back many times. I've got friends at the World Trade Center today. And so what we want to accomplish today, carrying the baton, is taking gains, not chances. We want to make money trading, not lose it, which reminds me of a story. So I grew up on a cattle ranch, and it's a very short story. So I can legitimately relate this. But there were these two old cowboys talking to each other, and one says to the other, "Hal, I heard that you inherited some money." And Bill says, "Yeah, that's right. My aunt passed away." And they were quiet for a moment, and Hal said, "Well, what do you plan to do with it?" And Bill said, "Well, I figured keep ranching till it's all gone. What we don't want you to do is keep trading until it's all gone. We want to take gains, not chances." And so I'm going to walk through that. And if you'd like to join along, follow along, go to marketstructureedge.com, hit that request a free trial button, put your name and email in, and you can do what I do in the latter part of this presentation. And if it's not for you, don't worry. You got no consequence or commitment. It'll last 14 days and you can play around with it. You don't have to put a credit card in, and you'll learn something. If market structure is not for you, and that's fine, then you'll have learned something. The time won't be wasted, but you can do something else. But I think you'll find this very interesting. I offered some of this already to Neil, but the reason we have something to say about this is that Edge is about beating the market by understanding it. And we're a nationally recognized authority on market structure. In 2017, I was asked to testify to Congress in written form on how to improve the market for issuers, those are public companies, and investors, because we're recognized for knowing the mechanics of the marketplace. A company I started in 2005, I'm getting old, modernir.com, is the largest provider of quantitative equity market data to public companies. They use it to understand what the money's doing. It's the same purpose that Edge is designed to do, except that you want to know what the money's doing so you can profit on it. That's the only difference. Both are fintech companies, financial technology companies. We're both are market structure experts that build software and algorithms and mathematical models, because the market is mathematical, based on market rules. And that is market structure, the behavior of money behind price and volume in context of rules. There's an ecosystem. There is a physics. The planet is governed by physics. How we behave on this planet and how we age and what we're able to build and do are governed by physics. And the market is similarly governed by a set of physics called Regulation National Market System. You don't have to know all of that, but we've built that into tools that you can use. And you might say, well, that's all very interesting, Quast, but timing the market is folly. Nobody can do that. This is what we all learn as, like a bedtime story. You can't time the market. Well, I'm not saying time the market. I'm saying understand it. And I would say that answering a matter before hearing it is folly. That's a proverb. So hear me out and see if the proof bears out in what I'm passing along to you. So there may be folks on this call who don't know, or on this presentation. Call is what we used to say in the 90s. So Benjamin Graham, not Benjamin Franklin. How many of you know who Benjamin Graham is? He's considered the father of value investing, and he wrote a couple of very important seminal books on securities analysis. That's the name of one, and this one, The Intelligent Investor, is sort of the Warren Buffett way of investing, and it purports to say that you can't time the market, that missing out on the best days by trying to avoid the worst days is disastrous to your performance. That intelligent investing is understanding what creates value. I'm not knocking any of that. This is not a not Benjamin Graham session at all. Those are all true. The data that are generally presented in various forms and ways will attempt to make that point, and it's not lost on me. Just follow me here. So this data is from Bank of America's latest iteration. People do this all the time. This was in March of this year. And CNBC ran an article, as it is wont to do regularly. And it says that between 1930 and 2020, so 90 years, over that 90-year period of time, you could have made 18,000%. Of course, you have to realize that the dollar in 2020 is worth 3 cents of what it was in 1930. So you'd have to divide those returns by 97%. But here's the key thing. So that is meant to tell you, well, you can't time the market, because if you excluded the worst 10 days per decade, I don't believe their math, but they would say, well, you could make 3.8 million %. But if you missed the 10 best days, you were only up 28%, minus the 97% of lost purchasing power. Well, to me, as a quantitative data analyst, I look at that and say, well, it appears to me that what we should conclude from this is that we want to miss the bad stuff and capture the good stuff. That, to me, would be the answer. And let's zoom this lens in. I realize this data might be a little bit difficult to see, but we're looking at the Dow Jones Industrial Average and the NASDAQ Composite over the last 20 years. So they're key milestones. So up here, here's the peak of the internet bubble for both. And then the trough for the internet bubble, then the peak before the financial crisis, the trough during the financial crisis, and present, back out 270 points from Friday. So that's 34,600 on the Dow. And over here on the right side, and it's not super easy to see, but what I'm pointing out is this. Suppose that you decided in 2007 that you're going to retire in 2009. So you had your investments in conservative things like blue chips that paid dividends and weren't volatile. Well, then in 2009, you're back as a Walmart greeter because you lost 54% of the value of your portfolio. What if in 2000 you retired because you had made a crap ton, to use a Latin term, buying internet stocks? By 2002, you'd lost 80% of the value of your portfolio. And I think there are core points here. Here's another thing. If you look at the trailing 20 years for both the Dow Jones Industrial Average and the NASDAQ, they're both up about 200%. So 202 on the NASDAQ, 198% on the Dow, but you got to back out to about 2% decreased purchasing power, inflation per year. That takes you to about 150%-ish. Back out taxes, and you're up about 5.5% per year. I'm not knocking buy and hold. I have them. I have managed accounts. I have a lot more money in private businesses. I like to trade the public market and invest in private businesses. My private businesses have, over the past decade, have grown more than 55% annually. That's a much better return than 5.5%. That's why I do it, right? So it makes sense. But there are lessons for us here. There are 4 flaws in buying and holding it. Again, I do some of it. Our point here is, can we use math to improve these outcomes in less time? Well, clearly, avoiding declines while capturing gains is vastly superior. The data that we've been shown to prove buy and hold demonstrates that. Secondly, time is risk. Time isn't our friend. There is time decay. We age. The longer that you do something, the greater the likelihood that the unexpected will occur or something bad will occur. So we want to accomplish returns in less time. That is alpha. Alpha is performance above risk. Well, time is risk. So if we can accomplish the same returns in less time, we are improving productivity and we are reducing risk. Returns over time, number 3, are meaningless. What should matter is the returns over your time. What is your time frame? You can't just suppose, as is so often offered, that sure, buying and holding for 30 years is fine, but how does that happen? If you're young, you should begin young. I agree with it. I did too. But it's about what time you have. And then finally, the market has changed, and let's talk about that. So back in 1995, the Benjamin Graham model worked pretty well because 80% of the volume in the marketplace was derived from active stock picking. And if you had your money with people who were applying Benjamin Graham principles, how do you find good businesses and separate them from ordinary ones or bad ones? Well, that's a very good principle. There's no question about it. 90% of assets under management were actively managed. It was stock picking. Well, if you step forward to 2021, Benjamin Graham is the smallest demographic or constituency in the market. 90% of the trading volume in the market is driven by some other purpose or time horizon. Therefore, if you are doing what you did in 1995, there is a 90% chance, mathematically, we're just using probabilities here, of being wrong. Well, we want to improve the outcome, not degrade it. And this is why stock pickers have a terrible time beating the benchmark. It's because most of the money isn't trying to find the best businesses in the market. Here's data to demonstrate that. If you look at, this is from AllianceBernstein, broker-dealer and a wealth manager. It appeared in Morningstar. Morningstar has very good information. And this is saying, despite that long-term 20-year view of how the blue chips and growth stocks behaved almost the same, that ought to tell us something. Over the last 5 years, growth has outperformed value by almost double, 92%. It's the math. And the interesting thing is, if you followed the Benjamin Graham model, you would say the explanation for that difference is that growth stocks have a combined earnings growth rate and dividend payout. Probably the dividend payout will be a subtraction, but their growth rate plus dividends should account for the difference. But it doesn't. It accounts for 10 percentage points of the difference. You know what accounts for 82% of it? Paying more for the same thing. Multiple expansion, these words at the top, that is Wall Street speak for paying more for the same thing. You probably paid more for the house that you bought than the people who bought it before you. Somebody owned it before you. So you paid more for the same thing. Sure, there can be changes to it. But that is it, what it tells us is that our purchasing power is declining. But it also tells us that the market does not reflect Benjamin Graham principles. That is the point here. So what we should be saying is, how do we find stocks the market pays more for? Or even better, how do we capture gains and avoid losses? That's what we want to have. And we want a high probability way to do that. Well, Market Structure Edge is absolutely an answer to that. And I'll show you the math to prove it. And it's based on a very simple principle. There is demand and there is supply. This is the most basic economic principle. And I should point out that the reason that we struggle in our economies to get this principle to work is because modern monetary policy, and you could say modern monetary theory, but modern policy in monetary practice is to move the fulcrum. We move it toward demand or toward supply to try to even out supply and demand. Well, the trouble with that is it distorts our ability to understand what the correct price for things is. So that's a whole rabbit hole, and we're not going to go down it. But following this on Market Structure Edge, we want to find stocks where the demand exceeds supply because the probability is that prices rise. And we want to avoid situations, or short them, where supply exceeds demand because prices tend to fall. It's a very basic principle. The time frames will be short because of that graph that I showed you, where 90% of the behaviors in the market have a shorter purpose and time horizon than Benjamin Graham. And that's something to keep in mind. So here is a view of demand on top, the green part, this seismograph, that is the price of Moderna, mRNA, over the last year. And here is supply. Supply is short volume. I'm not going to bog down in those today. If you want to get more, do a demo. A live demo, you can click through and we'll talk through that and do the trial, and we have little videos on all these kinds of things. But I just want to isolate this. If you looked at demand as the green parts of the graph and those circles that are forming as the swales, the point where there was more supply than demand, in most cases, that's where the declines occurred. So if we could avoid those and keep the green parts, just keep the gains and avoid the losses, it doesn't matter what you pay for something. We just looked at that data. The market is willing to pay more for something. Well, this is a great example of that. Who cares if that's how the market is motivated, so long as we can avoid the losses and keep the gains? I've drawn a little box here around this period in March where the math didn't seem to match, and we noticed it. The demand side was good, but the supply side was not so good, and the price did not perform well. Well, we wondered what had happened. We found out later, at the end of March, what described what occurred at options expirations during March. Archegos Capital, big hedge fund, blew up, cost billions of dollars for the big banks, prime brokers they're called, who supply services and derivatives and leverage in the form of borrowing to hedge funds. So I like to avoid those periods. I portage around options expirations because things can happen that you don't expect and can't see. Well, if we avoid pitfalls and we keep gains, we will be successful. So here's our big lesson. And to me, it really stands out clearly, but we'll look at the math. If you can capture strong demand and avoid weak demand, it's demonstrably better than guessing. Take gains, not chances, one of our favorite sayings. And it's better than buying and holding. And you might say, well, Quast, so what? This is all very interesting, but what we care about is trading. All right. Well, let's go do that. Let's go have a look. We have a decision support platform. That's what it is. But let's go over to app.marketstructure.com. That's where the actual app is, or marketstructureedge.com will get you there. So I'm going to escape out of that and go over here to the. I'm going to go to the dashboard. We're going to come back to this portfolio. This is the dashboard at Market Structure Edge. It's what it looks like. So the dashboard is the bridge of the ship. It is the captain's place to see everything that's going on. And these are the demand curves and the supply curves. If all the demand curves the last week are tailing off, well, what do you suppose the stock market is going to do? Wouldn't it be nice to know that demand is falling everywhere? Well, you can know. You can see when it peaks. It's a very good measure of supply and demand. I'll point out, too, by the way, that if you look at COVID's got this group, 11 companies, and if you want to know, send me an email at tq@marketstructureedge.com, and I can share the components. But there, the demand slope is rising and the supply slope is falling. It could be that these stocks might do better during this period if demand is increasing and supply is declining. But it will immediately tell us trends. We actually have a big thing to do that called broad market sentiment. And generally, when it tops, it gives us a predictive warning that the market is going to fall. Here, the market continued up for a little bit, then it fell apart right at options expirations in August. I avoid those. All right, so then it bottomed, nice opportunity for returns. Now it's peaked, probably the market declines. That's a very good principle. So the same principle applies to individual stocks, supply and demand. Let's go into the portfolio here, and I'm going to go down to Tesla. This is how we think about stocks. It's not a chart. You can chuck the charts and the financials. We care about supply and demand. It has proven far more predictive than any other thing. It's like Winston Churchill described democracy. It's the worst form of government in the world except for all the others. So there's no perfect system, but this is darn good. So here's Tesla. It's a 10. That means that supply demand fulcrum has tipped so that it hit the ceiling, and it spent at least 2 days there because it's topped 40% short. Yet Pfizer's has a lower supply level than Tesla. Tesla's actually pretty good here. Trades $31,000 every trade. It trades 200-day average 800,000 times a day. Last 5 days, 400,000 times a day in 30,000 dollar increments. Very active stock. So if we looked at the supply-demand equation, just these top two graphs, it's pretty clear that if you sold when it was peaked and you avoided all of these declines, this is price, this is demand, and then you bought rising demand, now you capture the gains and avoid the losses, and we can mathematically test that. My philosophy professor in college used to say, he was Greek, give me examples. I want examples to understand your point. Well, here, if we just look at what we call 5-5, that's the fulcrum. It's at 5, it rises above it, and then it returns to 5. What are the gains? Well, 9%. Over, this is a 90-day period. We produced 9% over 50 days, half the time. And Tesla buying and hold is up 10%. So we've already sort of demonstrated that is better. But if we look at it this way, we saw that buying rising demand makes sense. Well, let's say, what if we bought the uptick over that period of time? Now, all of a sudden, we have 16% returns, well better than buy and hold in 63 days. That's what we're after. If you can mathematically demonstrate that buying a certain mathematical number, you don't have to overthink it. It's not 5.2. It's just the fulcrum. I want to buy rising demand, and then I want to leave when demand returns to the mean, because that probably means I've exhausted the returns in Tesla. Well, I've done 50% better than buying and hold in 2/3 of the time. That's what I mean. That's what you want to accomplish. So let's go back and try another. Let's look at Pfizer. Pfizer is a blue chip of blue chips. It spends a lot of time at 5. If we back up and look at the last 3 months, this is really telling. If you had bought the rise above 5 and sold the return to it, you could capture all those really nice gains and avoid the decline. You could capture gains as long as it was above 5, but the good gains, the market-beating gains, came when it rose, when the demand increased. Well, let's go back test that. That's what I'm doing, by the way. I'm clicking through to our backtesting engine called Profiler. So if I look at If I look at the data here for Pfizer, buying the rise above 5 and selling its return, it's a 12% gain. So this is a 90-day period, 12% gain in 40 days. You'd say, well, is that great? Well, it's a lot better than the long-term gains in the market. The market averages 0.1% per day long-term. My objective is 1 to 3% per week, and I'm crushing the market. So that is beating the market by call it 300%. If you bought and held it, you'd made 14%, but you'd had to hold it for 90 days. Now you have that money freed up to do something else. That's the whole idea. Let's go look at another one. So if we look at, let's look at Nikola. Nikola's kind of the outlier. It's not a liquid stock. It trades $2,000 at a time versus $30,000 at a time for Tesla. But it's another great example. Let's go right over to Profiler and look at this. So if we look at buying 5.5, I mean, it's pretty darn good. You know, the Nikola is down 7% buy and hold over the last 90 trading days. But we could trade it just 46 of those days. That's what we're doing, by the way. What we're doing is we're saying, let's go buy the rise above 5 and the return to it. And then we'll wait for the rise above 5, do that again. And there were 3 opportunities to do that the last 90 days. And we made 18% even as the stock went down. And if we change that just a little bit and say, well, what if because it spends 21 days at 10, that means 80% of the time roughly, or you're going to capture 80% of the gains by selling at 10. Maybe we do that. Well, now it's only an 8% return, but I did it in 12 days, right? There you go. That's a wonderful return that will absolutely crush buying and holding. I mean, now I've got, 78 days to go do something else. Now maybe I go trade Tesla, or maybe I trade Pfizer. Just keep moving the money to where there's rising demand and I can produce a return. Take gains, not chances. And mathematically, there are 3 trades here. Each of these were 4 trading days. So that's our 12 days. And we had a 100% probability of at least breaking even because we made 6%, 0%, 2%. Probably could make money here if we held it a little bit longer. But the point is, the math is in our favor. That's what you want to do. You want to put the math in your favor. And the best way to do that is to test the data. Let's look at one last thing and we'll wrap up here. How about cassava? I mean, cassava is just the craziest thing. It's, by the way, we can isolate that. You know, what are the characteristics of the best performers in the market? Over the last 90 days, cassava's up 73%. See that? And that's in 59 days. Our active trading days means that's the amount of time we were in the market. Time is risk. If we held it for 90 days, we made 21%. So we absolutely crushed buy and hold by trading. And let's back this up. How long would this have been true? Let's go, because you could trade the same thing all year. Dennis Dick does it, pre-market prep show. He will sometimes trade a couple of stocks for a year. So let's just go back randomly to November. Now look at this. We made 537% just trading 5.5, and we only had to be exposed to the market 131 days out of the 213 that exists between now and November 5th of last year. Buying and holding, 382%. Over and over and over, the math tells us that that's a high probability outcome. Now, it's a very risky trade doing that. Here's something, I'm leaving this for you. So you could buy Sava here. Here's your trading day. 26 days, you made 518%. But the next 3 times you lost money. There's a lesson. When a stock goes way up, don't try to repeat it with the same stock. Why? Those behaviors. Passive money will be overweight this stock. Wait about a quarter, everybody rebalances, then the money comes back and you could make another 138%. Now we're 2 down periods in a row. Does that mean we've got one more of those and then we might make money in Sava? Well, let's create an alert. Let's tell the system to tell us when it's 5.5. Let's wrap up back here with the lessons. That's how to use math to beat buy and hold. And I just want to leave you with this very simple principle that says a key principle of edge success is that gains result from buying rising demand and leaving when those conditions reverse. And portage around the falls, options expirations, month end, stuff like that, where there are unknowns, just take your money and move it around. Broad market sentiment, Use that to modulate your exposure. When it peaks, take some money off the table. When it bottoms, put some more back in. I'm generally in the market to some degree, but I modulate it that way. And that is how to beat buy and hold, by understanding the market and taking gains, not chances. Give it a try.
Well stated, Tim Quast over at Market Structure Edge. Let's get that link up. Do you have a slide that's got the URL on it?
Sure, I do.
Tim?
Yeah, absolutely.
Get on over there. It's a 2-week free trial. There's nothing else like it. It's everything that he just went through. There's nothing else like it. Period.
Thank you.
So every time, Tim, that we have you on, it's always, it opens eyes. So guys, definitely check it out. And as Tim stated, there's a lot of resources there to get you up to speed to understand exactly how this new sort of data and information can help you be successful in the markets. Tim, thanks so much for being here with us today, Market Structure Edge, and have a great weekend, my friend.
Pleasure, and we appreciate the opportunity. Thanks, Neil. You have a good weekend too. We'll see you soon.
See you soon.